Twitter, YouTube, pretty much everywhere and in person. So let's get the ball rolling here. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. Today I'm joined with my good friend, Doug Hagerin. Hey, Doug.
Hey, Kirk. Happy post-Thanksgiving. Hope you had a nice one. And to all those listening, did you go with modern day Thanksgiving or traditional Thanksgiving, venison or turkey? Because it does, because if you go back and look at the history, they probably didn't have turkey at the first Thanksgiving. But just a sidebar.
I don't look at history, Doug.
That's right. That's right. You're investing. Why would you look at it? Why would you look at history?
What does history have to do with the present, Doug? I can't imagine why it's relevant.
Well, congratulations then, Kirk. You're going to get along with most of the world these days.
And you know what? On top of that, I don't agree with history, so I'm just not going to read it because it doesn't pertain to me.
That's it's so long ago. I mean, that doesn't matter anymore.
Yeah, no, history doesn't matter. We should stop looking at history because it's totally irrelevant for today, because today is so much different than anything that's ever happened, ever.
Ever. That's like the 1970s, whatever, nothing there. Inflation, that was different inflation. 2008, whatever, credit, who cares? That was different credit. It's all different these days. It's all, again, thank goodness that nothing ever shows any patterns or signs that are valid for the future. I'm glad we ignore them all.
Yeah, we're just going to ignore everything except for what we want to see, which is pretty much what our society is nowadays. Is let's ignore everything except for what we want to see. And now into our show.
Hold on, let me go get my vacuum chamber. I'm going to go walk in. Sorry, continue.
Well, hopefully we're not included in that, and you don't ignore us. So anyway, so we're going to dive right in. So we want to. This is the first episode after Thanksgiving. Hopefully everybody had a wonderful Thanksgiving. Hopefully you spend time with family, or the type of family that you want to spend time with. We had a very quiet Thanksgiving, which was glorious. I love quiet Thanksgivings. Had a few days to myself to just relax and unwind. Hopefully everybody else here had the same. Started to put up my backyard hockey rink too, which I'm pretty proud of. Got the outline down. Haven't put it in yet because it's not quite cold enough, but the outline's there. I'm happy.
We were 5 degrees this morning, Kirk. I'll send some your way.
We were 23 in the morning, but then it gets up to like 40 or 50 this week. So it's, even if it did freeze, it wouldn't hold. We did get some ice though this weekend in the mornings, but then it melted. So still a little early for backyard rinks, but we'll get there. So I want to start off with a few things here. And I'm probably going to do this over a few weeks because there's so many of these, but I want to start off with a blog post, which was, I think it was written by Seth Klarman, who's a very notable hedge fund manager in the Boston area, and he's a value-oriented manager, which tells you he must be really good if he's making money in these times in the last 20 years when value is completely out of favor. But very smart guy, very successful, and he penned this post, The Forgotten Lessons of 2008. Now, I think, I'll go over a few lessons here and there, but I think it's important to recognize that, here's a smart guy who in his periodic letter that he sends out to shareholders kind of pen these lessons, because really what's happening now is we're living in this Alice in Wonderland time, which we've been in for a while, I might add. So it's not like I just woke up and said, oh, things don't make sense. No, things haven't made sense for quite some time, and that could continue, right? And so I think what's important to take away from a lot of this is that rational thought has absolutely nothing to do with investing. Over long periods of time, that tends to be true, but not in any given moment. And today we're in one of those given moments. So I think it's just important to take away some perspective. So I want to kind of read these over the next few weeks, just a few each time, just to kind of bring some perspective. I want to give him credit because I think these are very they're wonderful, but I also want to be mindful of the fact that we got other stuff to talk about too. So first lesson is, things that have never happened before are bound to occur with some regularity. Wonder where that's taken shape. You must always be prepared for the unexpected, including sudden, sharp downward swings in markets and the economy. Whatever adverse scenario you can contemplate, reality can be far worse. That sounds about right. Yeah, I would say the last few years bring that into light very well. COVID being a notable example, last year being a notable example. So, and from everybody I've spoken to that can't tell the future, I will add, but the people that I've spoken to who I deem as pretty smart people have all kind of come to the conclusion that next year is going to be a mess. Now, once again, nobody can tell the future, so take this all with a grain of salt. But I do point this out because there are a lot of things coming up next year, which I think are really important to note. So one is, I don't have the number in front of me. I heard this earlier and I'm spacing on it. It was either somewhere between a third and 50%. So let's call it a third because I don't want to overestimate. At least a third of the US Treasury debt is coming due in the next 12 months. Now, that should scare the pants out of everybody because most of the Treasury debt coming due is at old rates, which are close to zero. And now they're going out at 5%. So that should scare the pants off a lot of people. And we noted on the show last time, and I can't remember if I was with Doug or if this one was Phil, but how Janet Yellen should be drawn and quartered and tarred and feathered and burned at the stake because of her activity of not rolling over the debt 30 years when the 30-year Treasury is like 1% and change. Now it's close to 5%. We can't do that. And that opportunity probably will never happen again. I'm not saying it won't, but trying to imagine how we're going to get back to 1.3, 1.5, forget what it actually got to in the low, on the 30-year Treasury, I think it's going to be hard to imagine that happens. So we'll see, but I think we're in a new era where the increase in yields, the increase in inflation is also going to increase volatility in ways that we don't expect. And I don't mean volatility day to day. I mean, things are going to happen that you don't expect because higher interest rates change the dynamics of the markets. It changes the dynamics of risk-free rate. We talked about this in one of the last shows on how if I'm comparing stocks with, if I bring up GMO, which is another notable institutional money manager, they have, seeing if I could bring up their stuff. So if I look at their they have a 7-year chart. I'm just trying to pull up the recent one without. I'll just do it while Doug's talking. But anyway, so they have a 7-year asset class monitor, and they don't predict that stocks are going to outperform 5% a year over the next 7 years. So what that means is that if you're comparing stocks for the next 7 years to treasuries for the next 7 years, the expected rate of return is higher in treasuries than it is in stocks. You might say, well, what are you talking about? Stocks have a higher return over bonds over the long term. Yeah, the long term, but not today, right? If you're looking over 50, 100 years, that might be true, but not in periods of time. So from 1980 until 2021, that was true. But during the 70s, it was not true because you could have bought a 30-year Treasury for around 15% in 1980, 81, I think it was, and you could have got 15% a year on your bonds for 30 years. You couldn't do that on stocks. Stocks did very well. They did not do 15% a year. So surprisingly to most people, bonds, so if you look at 30-year zero coupon bonds, they drastically outperformed equities over that 30, 40-year period. Drastically, like not even close. Most people don't realize that because they get brainwashed by Wall Street that equities are the way to go. Equities, equities, equities. But yet, equities are a small part of the overall financial markets. Bonds are enormous compared to equities. But people don't talk about bonds. Why? Well, because they're boring and they're hard to sell. Big institutions buy them. Individual investors don't, because why would you want to own a boring bond earning 5%, 5.5% a year? That's boring. Yet, if you look from 2000 to 2013, if you had bought a 5 or 6% treasury in January of 2000, you would have done very well over the subsequent 13 years. You would have doubled your money easily. Stocks, you actually lost money over that 13 years. It wasn't until July of 2013 from January of 2000, over that 13-year period, that the stocks actually broke even and started to make positive grounds. So you've done very well in bonds. The point being isn't that you should be all in bonds or all in stocks. The point is you have to be mindful of the environment and that not every environment will produce the same results. If you buy a stock with a PE of 200 compared to a stock with a PE of 1, you have a much higher probability of success with a stock of PE of 1 than one of 200. The reason being is it's going to take you probably your whole lifetime to make your money back on that stock with a PE of 200. Whereas a stock with a PE of 1, it's not going to take you very long. Now, that has nothing to do with the quality of stock. And if a stock has a PE of 1, there's probably something else going on there. But the point being is numbers, looking at only the numbers and not the quality of the stock, you want to pick a stock that's cheap. Because if you're buying a stock today, I'm not going to bring a stock up, but let's say you're ABC stock, right? You're just Acme Corp or some imaginary company, and you buy the stock with a P of 5, or let's say a P of 10, versus a P of 30. P of 30 might only give you 5% return a year, whereas a stock with a PE of 10 might produce 18% a year, right? So which one would you rather have? Well, I'd rather have the 18% a year, right? And so when you buy and the price you buy it at is a big determining factor of your long-term success. So anybody who tells you that long-term investing, buy and hold or buy and hope or whatever strategy they use, that's okay, but it depends on when you buy it. So if you buy tech stocks at the peak of 2000, I think, was it Cisco still hasn't exceeded the peak? Like there's like a handful of stocks, tech stocks that still haven't exceeded the peak of January in 2000. So what that tells you is you bought them poorly, right? Now some stocks have done well over that subsequent, 20-year period. I mean, look at Apple, Microsoft; they've been around and they've done really well. But point being is you have to be mindful. You can't just blindly go in and assume that everything is going to work out because you followed some mantra that some clown on TV told you, and you said, "Well, everyone says this, so it must be true." You have to be thoughtful about your investing, and that's what we try to do here. We try to open your mind to how to think about things so you can make thoughtful decisions. And one of those decisions is, should you buy stocks now or not? And I'm not telling you what to do because I can't, because unless you're a client, but I can tell you that I would not be personally be a buyer of stocks here. I think things are way too expensive, and you could argue till you're blue in the face that, hey, it's a good time to buy, but you're probably telling me it's always a good time to buy. I would say, well, there are times that are high probability and times of low probability. Right now, this is a low probability chance of success. So could the stock market go up 50% from here? Absolutely, it can. Absolutely. Anything can happen. Could it go down 50%? Absolutely, it could. I would say the probability is higher of the latter than the former, but hey, these days, all the Fed has to do is print money and bail everybody out. They haven't signaled that they're going to do that at the moment. So we'll see. I think that the market does need to sell off. And when that happens, we'll have to see how the Fed reacts. And depending on how the Fed reacts, that will determine course of action from there. I think all of you listeners need to be mindful of that because the Fed stepping in and printing money and lowering rates is a sign that they're looking to boost the economy again. So if we go down 40, 50, 60%, you can probably see that'll be in the works from the Fed is, all right, it's time to bail people out. But we don't know. I mean, inflation's a big problem. This is what happened in the 70s. Everyone said, oh, it's all fine. The water's great. They lowered rates. All of a sudden, inflation picked back up again. And then it was really hard to root out. And finally, Volcker was able to root it out. But it wasn't painless. It was a painful period for a lot of people. So just be mindful that the Fed's aware of this too. I don't know what they're going to do. I would guess that they've got a balancing act between inflation, deflation. All I know is we're going to see some carnage at some point, whether it's next year. A lot of people think it's next year, but of course, a lot of people have been saying this for the last year and a half. I do think that next year we'll probably see something because of the debt rollover, the election, and you have this pending potential bank crisis too, which is a real problem that people are starting to talk about. It's not the fact that they're talking about it, it's the fact that more people are realizing it than did before. When one or two people know about it, it's not a problem. When a lot of people know about it and they start pulling their money out of one of the largest retail banks out there, that's a problem because we'll show you the numbers later. But based on the numbers, it shows that you probably don't have your money there. Yeah, I'm sure they'll get bailed out because they're one of the too big to fail banks, but I wouldn't have my money there. My money's tied up for a few months. Why do I do that to myself? Because if they have a run on the bank, they have to sell, and their losses are bigger than their equity, which means effectively they're bankrupt. And the Fed has to take them over, which of course won't happen, which means another bank, which I'm sure you can guess which one's going to take them over because they take over all the other failed banks. But someone's going to take them over, and the big keep getting bigger, and we'll see what happens. But it's not a good sign from what we're seeing. So, Doug, what are some of your thoughts?
Well, Kirk, I'm just going to take up the rest of the time just to counter and continue on everything you just said. Because you touched on so many things that as you were talking about just one, two, or three of the points that were made in that blog, you uncovered several other points that he made with some of your points. First of all, I think a really important one, going backwards, you just mentioned, number 16 on it. Financial stocks are particularly risky. Banking in general, in particular, has a high leveraged, extremely competitive, challenging business, right? Another one that that's mentioned on there is, again, the government. Ultimate short-term oriented player cannot withstand much pain in the economy of the financial market. So bailouts and rescues are likely to occur, though not with sufficient predictability for investors comfortably to take advantage. I'm not going deep on these because we'll have more talk on these as we go. But another one, number 14, beware leverage in all its forms. Borrowers, individuals, corporate, government should always fund their liabilities against the duration of their assets. Look, I don't know if you've seen that. Not necessarily not necessarily right now something that is in sync anywhere. We've seen rising debt, government rising debt. This continues to hold true. Now, the thing that I thought was interesting, though, is the false lessons. Okay. And these are the things I think really matter here. First of all, what is a false lesson? Buy the dips, right? Number two, bad things happen, but really bad things do not. So go ahead, buy the dip, especially the lowest quality securities when they come under pressure. You just mentioned some people say, well, then obviously now is always a good time to buy. We've seen multiple times where that is absolutely not the case. Another one is there's no amount of bad news that the markets can't see past. It's always priced in, right? We've talked about that. I would argue it's never priced in, Kirk. As much as they say it's happening, no matter what they talk about, the instant that news hits, the market reacts to it, and sometimes it implodes. Another false lesson: there's no long-term lessons ever. So again, if this was a real, truth, a real lesson, we could actually say seriously, forget what happened in the 70s, forget what happened in 2008. You and I don't believe that. We know that there are lots and lots of long-term lessons. Markets don't have to be, markets need not be in sync with each other. Simultaneously, the bond market can be priced for sustained tough times. The equity market can be for a strong recovery, and gold for high inflation. Such apparent disconnect is indefinitely sustainable. Again, what are we talking about? No, you can't. You're talking about treasuries potentially doing better. That's one of the reasons that's possibly going to occur. Again, is because they have been so beat up. Now you take a look at equities. The long-term outlook for equities is not going to be necessarily positioned for strong recovery, okay? This is a false lesson. Another thing, going back to the leverage of financial companies, in crisis, stocks of financial companies are great investments because the tide is bound to turn. Do you believe that financial companies right now are going to be a great investment? They are probably positioned to be one of the most troubled assets out there, given what they're holding on to in terms of unrealized debt. Again, as we've said this before, as long as they don't have to sell them, there's no run on the bank, Kirk, the banks are fine, right? They can just wait for that stuff to recover. But it could take them years. And again, as I said, and he said, the government doesn't tend to be very patient. So if it all collapses, they'll probably step up with bailouts. Last thing I'm going to talk about on that, just again, because I could just keep going down this rabbit hole here. Another false lesson: the government can reasonably rely on debt ratings when it forms programs to lend money to buyers of otherwise unattractive debt instruments. Just in the last month, how many different debt rating changes have there been? Right? All you can rely on that We've went through this before. Debt ratings, a lot of opinions. Who knows what's making the deals? How many are they coming out? I think they're more aggressive than they were. Clearly, the debt, it seems as of now, the debt rating companies have learned some lessons from 2008 when they were still telling us all of this leveraged debt was high quality. Another thing, the government can infinitely control short-term and long-term interest rates. Again, I'm talking about all false lessons here. What is the government trying to do right now? Control those interest rates. They only have so much power to sustain that for so long. And the last one that, again, I'm going to touch on, the government can always rescue the markets or interfere with contract law whenever it deems convenient, little or no apparent cost. Clearly, the one takeaway here that seems to be very apparent from Seth Klarman, he is not a Keynesian. He is a firm believer that the government, as much as they would try, and as much as investors believe that the government believes it as well, he believes there's going to be a lasting legacy of government tampering with financial markets, the economy, the impacts of this. And eventually, again, there's going to come a point in which they're going to have less and less effect. Let's look at the interest rates when they were lowered. They could only go so low before they ran out of options. Now they've raised interest rates. That gives them the option to go back down. But again, there is massive impact of every one of those changes. But we're already starting to see the impact of those changes become diminished over what they used to be. And I think a last one that I love, again, is, and this is not one of his false lessons, but just remember this, number 20, almost no one will accept responsibility for his or her role in precipitating a crisis, not the leveraged spectators, not the willfully blind leaders of financial institutions, and certainly not regulators, government officials, rating agencies, or politicians. Again, at the end of the day, they all wash their hands. So remember this, you have to be making smart decisions with your money, and you have to really be understanding what's going on and prepare yourself for the fact that, again, there's a lot of bias out there. There's a lot of people with their hands in the cookie jar. And at the end of the day, history can repeat itself. And if all the signs are there, sometimes it's not a good time to cross the railroad tracks.
Yeah, those are great, Doug. And I always blame the speculators because they're always the reason that the markets fail. It's the speculators, always the speculators. For the last 100 years, I saw a YouTube clip the other day, and I'm trying to remember exactly the reference here, but I think it was Irving Fisher, Ken Fisher's dad, who was talking about. It was funny because what I saw was like this black and white video, and it looked like a hostage video, which is what made it memorable. Is he was reading it as if he was reading off a script, which back then I give him a little credit because back then things were different. It's not like today where people have a better understanding of camera and angles and all that. But it was like it looked like a hostage script, like the markets are okay. There is nothing to see here. Like it was that kind of a video. But a lot of the blame was put on the speculators. Every single time there's a crisis, it's the speculators. Well, I can tell you one thing: the speculators are what fix the problem, as well as it may cause it, but they also fix it. It's kind of like saying, well, you can't short the market. Okay, so what do? You just sell it and go to cash? Like that just creates other problems. So I think what politicians typically do is they typically find a blame, and it's usually like a single person that caused the financial crisis, the housing crisis, or a single person who brought on this credit default or whatever. They try to find a single person, or the speculators are always to blame. It's not the speculators. Speculators are all of us. We're all speculators. You could say, well, speculators are traders. No, they're really not. We all are speculating on investments unless you own the company, you've owned it for you're a family owner and it's a family owned company or something like that, and you're never selling. Okay, it's not speculation. But if you're buying and at some point you're going to sell, you're speculating on the timing to a different degree, obviously. So I want to get in some charts here. I wanted to share some of these because I think they're important to reference now. So this one is University of Michigan buying conditions for houses. And I want to bring this up because we talk about housing a lot, but we're not going to dig too deep into this other than just show how it works relatively. Okay. So this is somebody else's chart, but I just saw it and I'm like, all right, this kind of brings it into play. So if you look back in 2004, 2005, it hit a high of 160 something, 100, close to 170 on the conditions. And now it's at 33. So if you look all through the tens up until pretty much COVID, and then it's just declined significantly in large part due to rising interest rates. But if you look at the buying conditions, this is not even close to a dip. This is a crash in buying conditions. So this is, and we talked about the first sentence in the show, how we like to find things that align with our own thinking. Well, we've been talking about this for a while, and I don't think you can even speculate on the meaning of this. You just have to look at it and say, yeah, it's pretty obvious that buying conditions for houses is in the toilet. I mean, I'm wondering how it's even at 33. But I guess there's some people buying with cash, but apparently not that many. But there's some. I also want to show the next one, which is the consumer survey, the New York Fed consumer survey, which talks about obtaining credit. This is just, like I said, somebody else's chart, but it just shows that obtaining credit has become a lot harder after 2000, and then certainly in the last 2 years. And I think this kind of brings up, don't worry about the numbers, focus on the trend, right? And this is what we talk a lot about in the show. Numbers can be manipulated, but the trend generally isn't. So you might say, well, it really shouldn't be 20, it should be 16. It doesn't matter. The trend is up. We can look at the chart and say, obviously, the trend is up. You don't even need to look at the chart, okay? I don't even know what my credit card interest rates are now, but I think they're like 29.999, and I think my lowest one is probably in the 11. Bank of America. I don't think they really. I don't think they're keeping up with the times. Every single other credit card's like 30%. I've seen someone else has like a 36%. I mean, it's crazy. I imagine, and I have good credit, so I imagine people with poor credit are probably 50% at this point. But the challenge is you've got this time period where everyone knows that defaults are going to start to happen. Credit card companies know it, banks know it, so people aren't lending. So banks aren't lending. Credit card companies, I'm surprised they haven't cut credit lines, because at this point you're basically, people are on track to max out their credit cards, and then what do? Well, they just start defaulting on their credit because they still need money and they can't pay it. So what are they going to do? And so you're going to get a lot of this kind of back and forth. People are going to start credit card juggling. Pay it down. It costs 4% to move your money, but then you get 0% for another, year and a half. Well, that's great if you have a 33% interest rate. If you're carrying a debt, it's awesome. But I think it's just important to note the dynamics that are going on in the credit markets right now is that you're starting to see a lot more defaults. You're going to start to see a lot more hard times with consumers. I know Doug's going to talk about this a little bit more, but and I'm going to show one more chart here and then hand it back to Doug for a minute, is that when we're looking at conditions, I'm trying to show you a few charts that are showing conditions, just to kind of paint a picture for what we've been talking about for the last 2 years of what's going to happen, and it's really starting to hit the fan now. It hasn't impacted the economy yet, although what I've seen superficially is tons of Black Friday sales, Cyber Monday sales. I mean, obnoxious 70, 80% off sales for stuff that's scalable, like information products or technology. Just massive sales going on out there. And some numbers show that there's a pickup in buying, but not for big items. So I'm curious to see what the data holds over the next week and see what comes out. But it's not convincing me one way or the other it's going to be good or bad over those holidays. But some of the data is interesting because it aligns with the theme that we've been talking about, which is consumers are running out of credit, they're running out of cash, and sometime in early next year, end of Q1, maybe I think May is the statistic somebody had told me earlier, but it may be sooner depending on people's spending. But a lot of people I know, they're not spending as much this holiday season, and people are tightening their purse strings quite a bit. So I do want to show this chart because I thought this was interesting. So this is by Hussman Strategic Advisors. John Hussman's great with data. I recommend sign up for his stuff. It might be over your head because some of the stuff he talks about is over a lot of people's heads, but I think he puts together some great data and great statistician with this stuff. So he put together this employment-based recession composite index, and the point of this is to take 7 different indicators, and what he does is to explain the chart is he looks at 7. So if none of them are showing a recession, so each one has its own independent signal. So let's say one of them is unemployment rate that's above the 12-month average. Okay, that's one of the indicators. So he has a metric that he looks at and says, all right, if it says here, if it's more than 0.3 or above the 12-month low, so he kind of lays it out. So basically lays out the rules and said, all right, if it's above this number, it's a recession indicator. Okay, that's in his words. I don't know if it's true or not, but that's what he deems it as being a recession indicator. Okay, so one of them is flashing red, but the other 6 are fine. No problem, right? There's plenty of those instances where there's one that's triggered and the others are fine, right? Which means that we're probably not having a recession. And then there's another one, and there's another one like total aggregate hours worked, production, non-supervised employees, temporary help services, unemployment, more than 15 weeks change. It's really, I would suggest go to the website and look because it's going to confuse you if you're listening to this. The point being is these are all like employment-based recession data. So his thesis is if you have more than 3 of these, 3 of these or less, that trigger red, meaning there's a recession, then there's no recession. And he shows this graphically and overlays it into recessions. And then if you look at it and say, well, if there's 4, 5, 6, or 7 of these are triggering red, it's a recession, which according to his data goes back to the mid 60s, shows that there's been a recession every single time. Now 2020 was a little bit of an anomaly because of COVID, so it was a very short recession, even though they claim it wasn't a recession. Whatever. I would say that was clearly a recession, whether they deem it to be or not. But what's interesting to note, the conclusion of my point is, out of 7 indicators, when you have all 7, it's pretty much hard recessions coming. Well, right now we're at 6. So anything over 3 means that a recession is coming. Right now we're at 6 out of 7. Well, what that tells me is we're overdue, right? And it may not happen tomorrow. It may happen 6 months from now or 9 months from now, but I think we can all agree that a recession's coming. It really just comes down to when consumers run out of money. When consumers run out of money, I think we're up the creek for quite a bit. And then the question is whether the Fed is going to print money again, cause more inflation, which causes more of a problem. So we'll see if they do that juggling act. But I think I really like this chart because it's just data centric and just shows, look, it's out of all the indicators we look at for recession, 6 out of 7 are flashing red. That's obviously a problem. And you should just note it, right? Doesn't mean it's happening tomorrow, but you should note it in the back of your mind saying the employment statistics show recession is in the cards and it's just a matter of time before it shows up. Doug?
Did you say noted or did you say ignored it? Because I still hear a lot of people out there saying to ignore it. Everything's fine and dandy. You know, prices are still going up. Everything's selling. People are still buying. I saw something today that came out about, you know, credit be darned, but people are booking these massive, international flights. And, but I think what's really interesting, one of the things, that the reality of it is that people have money. Okay. Let's understand what money is. Money is, in its essence, it's access to capital. Okay. Access to capital means you have the funds to be able to make that transaction. Now, access to capital comes in many forms. Some of it is having cash, right? And if you have the cash and you go out here and you spend that money, then that transaction occurs and it gets noted that the transaction, the sale occurred. But access to capital also comes in other forms of using other people's money or creative ways of using your cash flow. Okay. So when we see and look and say, look, everything's just fine and dandy, people are still spending. What they're doing is they're accessing capital for transactions for whether it's goods, whether it's services, whether it's technology. How they're accessing it is where you need to get under the covers. And this goes back to a famous quote for Warren Buffett, you don't know who's swimming naked till the tide rolls out, right? Okay. Right now, the tide is covering everybody up. Everybody's swimming. But a chart that's on there that, you can pull up is that, for me, Kirk, is they just came out with information that shows that buy now, pay later spending has starting to spike significantly. Okay. 20% compared to last year on Black Friday. We don't have the data on Cyber Monday yet, but they're expecting that to possibly spike by 19% to a record $782 million. Okay. As an excess savings in the U.S. have gone from $2 trillion to zero. Americans are relying more on debt than other. We've shown other charts that talk about the rise of credit card debt. We've talked about the squeeze on cash flow. We've talked about the impact of student loans coming back in and the impact of mortgages that, again, there were still a lot of people that weren't having to pay on mortgages. The federal government just had to come out and basically step in to help veterans, right? Because they were struggling now with the ability to pay on their mortgages. And again, listen, opinions aside, these are our veterans. So, we got to do a lot of things to support them, whether you agree with that or not. But the point here is, we don't have data as what this means right now. Are these buy now, pay later programs, are they zero interest? Possibly. People might be familiar with one of the entities out there, Affirm, or, Amazon has their own. Back in the day, a lot of this was similar to what they called layaway. Now, a lot of youth listening may not understand what layaway was. It started to come back a little bit. Amazon, ironically, has a layaway program. Back in the day, basically, you could buy something right now, but you wouldn't obtain that item until it would go into layaway, and then you'd make payments on it for an extended period of time. There would be fees on that. So that's how the retailer would kind of get some security, basically interest, if you want to call it that. Although it wasn't interest, it was more like one-time or single item fees in order to set this up. Most retailers have gone away from it. It's cumbersome. It's a pain for companies to use it. It basically went away with the rise of credit cards, because why would a company have layaway when you could basically put the layaway on your credit card, pay interest later? We all know what's happened with credit cards. Okay. And it's become a massive problem for many, many Americans. And we started to see that number go back up again. We are starting to see, though, layaway type programs come back. The issue with modern layaway programs, they're not necessarily called layaway, but these but there are layaway programs. And of course, if you don't pay, they restock, and there might be a restocking fee for that. So you're effectively paying interest on that purchase. And why would someone use a layaway? Maybe it's something that they need to get now that might not be available later. Cash flow is coming, whatever the case. But credit and some of these extended pay programs have often replaced that. And these extended pay programs may be zero interest. But here's the issue. Back in the day, if you didn't pay, you paid a restocking fee, it went back on the shelf. These days, a lot of these programs, if you don't pay, you end up paying the entire interest that would have accrued on the entire purchase from the day you acquired it. Okay. So it sounds all good if it's zero interest. And as long as your cash flow can cover it, and it's something that you would have covered anyway, maybe things are going to be fine and dandy. But as Americans are getting squeezed with greater and greater costs, greater and greater debt, greater and greater inflation, which I know we say has come back down, but it didn't. We've talked about this. It didn't get rid of the price increases of several years ago. So someone today bragging about what inflation, because gas prices have come back down. I don't know. Everything else, right? So, as people are getting squeezed, all it takes is that one moment that all of a sudden you have, trouble getting additional access to capital, and boom, now you add on that 10 or 15% interest all the way back to day one. This is a real issue. Credit card debt hits a record $1.06 trillion. Okay. This is not debt that's just going to be able to be wiped away. Hey, we got payments coming in, we'll just write it. Most of America does not have the ability to be able to do anything other than minimal or nominal payments on a lot of these credit cards as they get squeezed in other places. And eventually there's going to be a reckoning. So like you just said, Kirk, take a look what's out there. Look around you. Some of that, though, you're not seeing yet. Pay attention to things like this, because there's still a lot of people that are swimming under the tide. And all it takes is a turn of the winds. The tide goes out. and we're going to find out who's swimming naked. But right now, these are all components that end up going into into a recession. And if we do get there, and we have the job losses that come from recessionary forces, that's when all of these things start to crumble.
Yeah, no, I agree, Doug. I want to show one chart before we kind of wrap it up here. And somebody put this together. I just thought it was really well done, just visually. And so, people have different philosophies about investing. And earlier today, I interviewed a technical trader. I like doing that once in a while because we do have people that are interested in trading, and I think it's a tough skill to learn. If you're good at it, then it can provide you with some good insight for investing. Anyway, so this chart is basically, I'm not sure what colors, what country colors these are, but it's basically red, yellow, and green, and it shows the S&P 500 basically for like the last year and a half, maybe 2 years. And, we talk about in the show and how the indexes have basically gone sideways for the last like 3 years. So really this could have gone back another year. But for the last 3 years, the markets have gone sideways. And people say, what are you talking about? The market's up this year. Yes, it's up this year. It was down last year. It was up the year before that, yada, yada, yada. The point is if you look at the chart, the top area is green, middle area is yellow, and the bottom area is red. And the reason I put this up is because it shows that we are in a trading range for the greater part of this year. After Q1, we're in the yellow. We've been in the yellow most of the year. We were in the red in the beginning because it was at a low point in October of last year, and then in January it started to spike, and then March went down. So we had some rough areas in the early part of the year, but in a lot of part of the year it's basically bounced around a lot. Went up, went down, went up, and you could argue where it should be. It doesn't really matter. But the point on this is if you get into the green area, that means that the market's breaking out, and it's probably a good idea to own the market. It's in the yellow area. It's a trader's market. You can get in, you get out. Doesn't matter. It's not really going anywhere. In the red area is an area you should say, well, I should probably get out. Right? I shouldn't be in the market if it's in the red area because that's a bad sign. Now, this is why technical trading is valuable. There's actually more to it than this, but I thought this for people who don't have a background in technical trading, this chart really outlines one way to look at things. Now, there are many ways to look at things. 200-day moving average is a big one. 50-day and 200-day. There's a bunch of others. There's so many I couldn't count. But this is a very simple one, right? You don't have to know anything about anything to know that yellow is caution, red is bad, and green is good, right? If it hits the red, get out. If it's in the green, buy in. If it's in the yellow, you're not really going anywhere. You're just kind of treading water. So you can make an argument either way. Point being, this is how you should look at the markets right now. If we get into the green and we're relatively close to it, okay, now there's something to talk about, okay? Because the all-time highs were not much further than where they are now. Now, if we go to all-time highs, given the economic situation, I'd laugh really hard. But hey, people have to do what they have to do. My prediction earlier in this quarter was, well, either we're gonna go all the way up, keep going higher to the end of the year, in which case it's a great chance to short the market for next year, or it'll be lower and it's just going to be, who knows what's going to happen next year. So I think it'll be really telling to see what happens in the next 30 days, as typically December is one of the bullish periods of the year, and January is also a bullish month. February can be a good time for a pullback, but we'll see. So I think everyone should exercise some caution at this point, given where the markets are and given the underlying conditions. I think, we have a lot to be cautious about. And especially, as I said earlier, you're able to get 5.5% on short-term U.S. Treasuries to just wait. 5.5% is a pretty good yield rate of return. For those of you who think, well, I don't want 5.5, I want 15, I would listen to the show more often, because the 15% is a pipe dream. It happened for many years. It's a pipe dream right now. I think in short spurts you can, from October of last year to right now. Yeah, it looks awesome. You get great returns. Of course, the year before you lost a lot. So I think what matters in the grand scheme of things is where is your portfolio Is your portfolio growing, or is it just oscillating like it has been the last 3 years? So just be aware. Don't be a pig right now. So don't be piggish. Just you don't have to be a bear. You don't have to be a bull, but don't be a pig, as they say in Wall Street. You have to be one or the other, but don't be a pig. And I think right now is the time where you just have to be extra cautious. So don't be afraid to take profits. Don't be afraid to sit in the sidelines. Getting 5.5% for sitting in the sidelines is not a bad deal. So just be cautious. So Doug, final thoughts from you, and where can we find more about you?
Yeah, well, you're just talking about the market. I mean, according to bar chart, this is another chart we can look at, but basically, strategists were gloomy about prospects of the stock market going into 2023, and again, boom, it was up 18% year to date. However, again, we were also coming off of an atrocious 2022. So again, up 18%, we're still not necessarily making up for what last year's decline was. And I think that, as you mentioned, there's good times to be caution. One thing I tell people is, if you're relying on the stock market, and I do this math when I work with clients, Kirk, it's like, look, okay, we can look at the stock market. We can look at what you need to live a comfortable retirement. And let's see if we were just going to rely on that rate of return, what it would be. And it will surprise. If you're listening to this, and you've never done this, it's really important for you to find out what is the rate of return you actually need to get on an annual basis to be able to have enough money to live the life that you want to live comfortably in retirement. Okay. If you haven't done that, it'll surprise you. For a lot of people, that could be, almost a 15% annual return. Well, if you need 15% annual, ask yourself if that's possible. And if that is what you're relying on to achieve your financial independence, this is not a bullish sentiment. This is a bearish sentiment. This is a fear-based sentiment, because you're basically saying, I haven't saved enough, so please, stock market, help me. Well, hope is not a plan. Okay. So, going back to that, be prepared that if that is the hope you're relying on, that is a greed-based position. It is basically a desperation to achieve a number that is the most out of your control. And unfortunately, if that backfires, if we go into an extended situation where the market does not do what you're expecting, those averages get harder. And ultimately, at the end, you could be wildly disappointed with the outcome. So make sure you're doing your planning, and make sure you're also planning to put the pieces together outside of just hope for these types of returns, because they may not be there for an extended period of time, as we've already talked about. So, hey, listen, another thing about hope is hoping that college is going to be affordable. All right. So we know that debt has obviously spiked, not only on credit cards, but it's also bearing down on families because of college. I talk to families every day. And again, they think, I thought college would be cheaper. I thought I'd saved into my 529. I thought I'd have enough. And then we start looking at the schools they're looking at. And you know what? 85% of families apply to the same 50 schools. They don't get the discounts. They may have saved enough. You might have some cash flow, but you got to come up with $100,000. Listen, 100, 200 grand over 4 years. That's the price of a house. Okay. 100's a small house, but the point is, a really expensive luxury car or a small house over 4 years is a burden that most families can't afford. Do your planning, get the information you need. And you can start by getting that information at our website, procollegeplanners.com. Learn now, put a plan together. And if you have any questions, reach out.
Great. Well, thanks for coming on, Doug, and sharing your wisdom with us once again. And we're going to wrap it up. I think, once again, I appreciate all the listeners on the show. Give thanks to all of you. And please give us feedback, questions, all of it. We love it all. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. So please send an email to express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one. As I said earlier, I'm not selling anything. want them easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.